Welcome everybody. Study time with Steve. We've been doing these for a couple years, and I've never had Quentin as a guest. Tim before, but he's always been on vacation or doing other things. So this is the first time I've had Quentin. Quentin is our COO and wealth manager here at the firm. As hopefully everybody knows, I'm Steve Gormley. I'm the director of portfolio management for the firm. Wanted to show you the disclosure slide and uh, very important disclosures here. And then really wanted to get into, what I think is perhaps the most important slide that we're ever going to show you. The how many legs the Lunar New Year zodiac sign has really can tell us a lot about what the market is going to do for the next year. So we are in the year of the horse, and obviously a horse walks on four legs. And as you can see from this chart, four legs just means a good year is ahead of us. So, you know, I really wanted to start there because I thought, man, how important is it that the zodiac sign, the Lunar New Year animal, has four legs? Obviously, this is not something that we really care about or look into, but I had a slide and I thought it was fun, so I started here. We started getting these slides probably 2 or 3 weeks ago, and a lot has happened in the time since. But what I wanted to go into, what really matters, and I think the big thing that I wanted to talk about is the next slide, Jay. If you can go to one more, diversification. So, in this first few months of the year, large cap stocks have really just kind of flattened out. U.S. stocks are U.S. large cap stocks are basically flat on the year. This is from February 12th, so I have the new numbers. But you can see international and emerging market stocks were really doing great. Gold, by far the best, and small and mid U.S. stocks were doing great as well. I have updated numbers kind of over here on my other screen. Small and mid cap stocks for US stocks have basically stayed about the same, even after everything that's happened in Iran. Gold is actually up 18% now. Commodities are up 16%. A lot of that has to do with oil, and me and Quentin will get into what's happening there. International and emerging stocks have actually slipped. So emerging market stocks are now up about 7% on the year, and international stocks are up about 4.2, but large US stocks are still at a negative 0.2%. So when it comes down to it, even with large cap stocks doing poorly to start this year, our portfolios are doing pretty good. Last time I checked, they're up about 2 to 3%, even with yesterday. And yesterday started off pretty bleak, 2%. Monday started off, we were down 1%. We closed flat yesterday. We were down 2, closed only down 1. Today we're up pretty good. So it just shows the benefits of diversification. It shows how resilient this market is. And so, Quentin, let's get into what's going on in Iran. Let's talk about it because I know that's probably what's on most people's minds. So with, like, let's say commodities, let's start there with oil. What do you
Yeah,
think
well,
is the
uh,
overarching, like, what's happening right now?
well, I think there's a lot going on here, Steve. So, like, you mentioned, it's the year of the horse. So it's the year of the fire horse. Means a lot of what that means is just a lot of, I guess, a lot of fast-paced change. And like, if you're here in California, like a wildfire, just kind of moving through, lots going to happen. And that has definitely been what this year has brought for us. I mean, being in my role as the COO and a wealth manager here at KWB, today I get to talk with Steve and do this. I have client appointments this afternoon, but last week I was over at LPL at their home office talking with other advisors about our business and what we're seeing out there. And everything that's just happening so quickly. We were there, they were talking about Claude and how they were thinking about different things with Claude as an AI technology. And then I left there, and the next day Claude's in the news because of other things that are going on. So it's just there's so much happening so quickly. And we had it again over the weekend with what happened in Iran. And now, how is that going to play into a lot of the things that we're going to talk about? Because, Steve, like Steve said, we put some of these slides together a week ago, and then all of a sudden we've had so many changes. But I think what's great is that the diversification has helped where we haven't seen that in the past,
Yep.
maybe in different area, different times. Like there was a time when we were talking about diversification is dead and the death of the 60/40 portfolio. And now we're going into meetings and yeah, the S&P is flat or maybe slightly negative, but our portfolios are maybe sitting around two. And so now that's been a benefit to having these things. And we were talking for many, many years about internationals and emerging markets and those just, hurting the portfolio. But many of you have probably seen us bring up the quilt chart, and there's times when internationals just kill it and do really well, and that was what was helping the portfolios uh, more up until till recently. And so
Yeah.
I think even now with where we're at with Iran, oil prices, and all of that, it's like this diversification strategy is helping. As Steve said, we're seeing different areas get impacted, but it's helping the portfolios hold up so that we can come in and have conversations that are beyond just now it's beyond just like owning the US and what should we do there.
Right. And really that international underperformance over it's really only the last couple days. And what's happened there is that oil prices have spiked. Um, Most of Europe and the Far East get their oil from that, kind of centralized location. Luckily, as the U.S., we would probably, I would I think back to the 70s and what happened with like the oil embargo and everything that happened then. We don't have that problem in the US anymore, which is really nice to think about. Like we don't this supply shock that's hitting Europe, that's hitting other international countries, isn't hitting the US the same. Now, the market is going to react the way you do. And my big thing with market reactions nowadays is anything you see in the morning is all driven by computers. It is not people going out and selling right at the open. This is driven by algorithms that are running in the background, that are looking at news articles, that are looking at what's going on, and there's something triggering them to just sell. And today it was the opposite. Today it's buys at the beginning. So it's just one of those things where the day-to-day movements of the market are being dictated by a lot of other things than what they used to be. And that is going to play into your psychology when you see any of these, big headlines. We attack Iran. Um, all of these algorithms start triggering, like, okay, what does that mean for the market? And these are all their time frames are of seconds or minutes, whereas our time frames are years and decades.
Years.
And it's a completely different thought process as to what we are thinking about and what's going on in the markets than what happens on a day-to-day basis. So it's really important, from a psychology standpoint, to try and ignore what goes on a day-to-day basis. Actually, if you look in the blurry background of my of my video, it shows a days versus decades chart. So on the you get the wiggly line over there. That's the days, and the decades are more. This is what happens. So we've got to take our days as they are. Days are going to happen. Jay, why don't we launch the question that I had? Because I just want to get that out there. Let's launch the question. So go ahead and vote on the question here. Do you think, on average, in the 3 months following a major geopolitical event, is the U.S. stock market positive, negative, or flat over those 3 months?
And Steve, I think, with clients and the conversations that we're having in meetings, we get a lot of questions about, well, what are you going to do in the portfolio now that, this has happened or that has happened? And my comment to clients all the time is, you know what, we're making decisions every day on the portfolio. And some days that decision is to do nothing. And I know that that doesn't sound great, but you want to see action, right? Oh yeah, they're making changes and they're doing this because they're watching and seeing what's going on. But a lot of times this news moves so quickly that we want to kind of wait and see what's going to hold. I go back to, almost a year or yeah, almost what about a year ago ish, last year with Liberation Day, and people like, what are you going to do now? Because tariffs and this, are you going to place trades to reduce exposure in these areas? And there was so many changes going on that we couldn't make. The decision was to do a lot of nothing until we kind of made little adjustments. And so, I mean, Steve, you look at the portfolios every day and talk to the people that help us build out those models, and I
Yep.
expect that we might have some changes, but nothing major.
No, I would expect some changes, maybe lightening up on international stocks. And again, they've had a great run. So I think a lot of what happened with the sell-off in international stocks in the last couple of days is because of people like us, advisors who are saying, look, if I'm going to lower my risk, I'm going to take from what's done the best. So if you were here for our economic outlook at the beginning of the year, the slides that we showed how well international emerging stocks had done last year. So that just had continued into this year. So I would guess that a lot of people out there had an oversized allocation to international and emerging markets, and that's what happened. They just kind of they were taking their gains from where they were the most prominent, and it's just a rebalancing more than anything else. So not that it was right or wrong, and not that we know who's going to win in the coming months or years, but it was just one of those things when allocators rebalance things, it's going to come from what's done the best, and that's done the best over the last year or so. So
Hmm.
here's the results of the poll. So we've got 54% say that it's positive over the next 3 months. 21% say negative, and 25% say flat. So the actual number is it's positive about 2.5% over the next 3 months. And if you look over the longer term, depending on if you look at like average return or median return, because there's not a ton of numbers out there, but it's anywhere between, let's say, 7% average and about 11% on the median. So it's one of those things where if you look a year out, these things tend to not bog down the market when it comes down to it. The only thing I will say when it comes to that is that if the market is in or near a recession, the recession trumps whatever's going on geopolitical wise. So if you're in a recession, it kind of exacerbates the effect. But if you're not, the market just kind of trudges along and moves through. So that's the best thing we could say. We are writing a blog currently on it to kind of show a little bit more in terms of charts and graphs of what to expect. But really, when it comes down to it, as long as the economy is healthy, we should see the market continue to climb because companies are going to go out there and continue to try to earn. The one thing that concerns me is oil prices. Oil prices affect everyone. It leads to more inflation for us. We're going to have to pay more at the pump. Everyone who's shipping goods, either by sea or by land, they pay more for that transportation cost. So it's one of those things that it does filter into the economy. So we'll see how things react in the oil markets as time goes on. But really, stocks are healthy. I mean, companies are really healthy right now, and that's what's going to drive. That's going to drive the market over time. So why don't we get into the next slide? And this is Quentin. You go ahead and take it away on this one.
All right. So this is showing us, the Fed funds rate and versus the S&P 500. So the blue line is that S&P 500. The orange is where the Fed funds rate hits. And one thing that we seem to not be able to do is not talk about interest rates and what the Fed's going to do. We get that question all the time, and it's in almost every presentation that we do currently. And you know, the thought was, is the market addicted to interest rate cuts and what the Fed's going to do? And you could say that recently, more so in the last few years, yes, the Fed or the market has been addicted to interest rate cuts. We got accustomed to very, very low interest rates. And we want, and then they got spiked up with inflation back in 2022, and then started to go down. And we every time we're chomping at the bit, waiting for that to happen to get that rate reduction. And so now, what we're seeing is that with what's going on in the Middle East, and we have a meeting coming up, the Fed is kind of divided on what to do. Like there's some that say we need to lower rates, some that say we need to keep it kind of just flat for now. And with the new Fed chair coming in, the thought was that, hey, we're going to get some rate cuts. Looks like the market's probably pricing in about two this year, in 2026. And the the market's kind of sobering up to the idea that we're not going to have near zero interest rates. We're going to kind of be stuck, in this area. And what that chart did show is it really doesn't matter. We're not like the market still went up even with higher interest rates, and went up in periods where they were higher than they are today. So, does the Fed need to cut interest rates next at their next meeting? Probably not. The economy is chugging along. One thing that I think is interesting is we want the Fed to lower interest rates because we need to add fuel to the economy. Well, you know what? People are spending money. I haven't seen a decrease in the amount of money that's or people spending, going to the shopping malls around here, traveling and doing those things. But when you correlate that back to consumer sentiment, sentiment's like actually at not a record low, but it's at a historical low number. And then when you look on the flip side, though, at what the consumer is doing, the two just don't match up. We've got we've got low sentiment and high consumption. And it's not necessarily because of inflation. That's not what's causing the higher, like people spending more money. It's we're buying, more things than we did in previous years. There's more places for us to spend money, whether it's because you have to have Netflix, Hulu, Amazon Prime, Peacock, and not just, Spectrum and get your cable. There's, back before the iPhone, I mean, a lot of people we had our Nokia, phone, or we didn't have a phone and we didn't have phone bills like that. And so there's just more stuff going on. And there's this like keeping up with the Joneses kind of deal happening as well. So while yes, definitely the middle and lower class, like they feel it when they go to the grocery store. I mean, I've got four children. Uh, it's like a mortgage payment feeding them every month. And just the cost of fruit, is ridiculous. But people are still spending money, even though that's happening. And it is a lot of the higher income families is doing most of the extended spending on things beyond just the staples. We are seeing that, but across the broader economy, Fed lowers rates or not, people are still going along. And I think that plays into, Steve, what you were talking about with the recession. It's like
Yeah.
I don't know that we see that because people are still out there, going to Disneyland,
Yeah.
flying places, going to the shopping mall over here, doing all that.
It's the vibe session. That term was coined a few years ago, and it's really true. It's like people feel worse about the economy than they do about their own situation. They think their neighbor must have it terrible, but they're doing fine. And it's and I mean, all of this comes back to the news. The news is going to focus on the least best story they can focus on. Like, what's the story that will get people to watch? And our brains are triggered by bad news, not good news. So
Hmm.
everyone seems to think, hey, I'm doing fine, but my neighbor must be doing terrible because the news says things are terrible.
Yeah.
And it doesn't matter which side of the aisle you're on because it's bad either way. And they're complaining on both sides. And the reason is because people tend to watch when there's more to complain about. And
Hmm.
so let's go into another part of the vibe session
Yeah.
then with the next slide because this is another part of that's bringing in more of those vibes that are just terrible.
Yeah. So Steve, I mentioned that last week I was at LPL's home office visiting with them, and we had one meeting with their somebody who's in growth in at LPL, talking about AI and kind of scaring us to some degree, telling us that we're not going to need employees because AI is going to do everything. Then the next meeting right after that was how to build strong teams. And I was what are we doing
Perfect.
here? You just told me before I don't need a team. And so what this slide here is talking about is like AI and what areas is it going to disrupt? And it's an older chart, but I still think it plays into what's going on today because a lot of this hasn't changed. The yellow bands are the potential for automation. You can see that financial activities like our business has a lot of opportunity for AI to step in and help with automation. And then the lesser of those are going to be those areas of construction and agriculture where there's just not as much automation opportunity. The green band shows the unionization rate. So like how labor protection and who has that. Like utilities is one of the highest with the unions that they have. And there's a high level of automation that can happen, but also protection of their jobs, potentially. In our industry, we don't have unions that are going to fight for us to keep our job. But what I do see AI doing is, it's going to add to the production of our people and the economy. We're going to get to do things faster because we have the help of these AI things. I mean, our trader in the office, Ricky. I mean, he was telling us the other day about the Claude bot that he's building for his fiance's spider business and like what it's going to do. I mean, it's not doing everything, but it's going to be able to do a lot of the menial tasks of printing things and sending out a form email and that kind of thing so that you can go and do other things. And I see that happening like in our business. We use AI to, run meeting notes. We use it to do different analysis inside of maybe financial plans or taxes and that kind of a thing. And it hasn't removed my job and but it has made it so that I can do things faster. And what I do see is like our business here, we are managing, two or three times more assets with more people, but not to the level that it was before. Like we probably had, I don't know, maybe 12, 13 employees and maybe had 500,000 or 500 million, I'm sorry,
Yep.
in AUM. And now we're at like what, 1.5-ish, Steve,
Yep.
and we've got 21 employees. So when you look at the growth there and what we're able to do with the number of people, that's primarily because of technology. I think that, there won't be a day where at least for us where like every there's nobody but the advisor and AI is doing all of the processing of everything because there's still that level of the human connection. People want to talk to a person. Even not millennial and millennials want it, but even Gen Z, they're like they're hungry for human connection. They grew up in an era with, besides the pandemic, just like technology was everything. But they still want that connection. And I think that firms like ours that have said, hey, we're going to do the human touch first and layer in the AI to help productivity is going to keep it going. And I think companies are going to continue to hire people. Their job is going to change into like managing some of this AI and the people and less about the little tasks that we used to do on a daily basis and still to this day do on a daily basis.
Yeah, and so the majority of articles about AI are coming out about what's the negatives of that. All
Yeah.
these people are going to lose their jobs, and we're going to have 10% employment because there's no way that these people are going to find other jobs. There's no way that this is going to create jobs. It's only going to destroy jobs, right? So it's one of those things. It's like the vibes are terrible around AI, even though we know for a fact that what's going to happen is it's going to open up jobs in other areas. Now, I don't know how paying they will be or what they will be, but there are going to be other jobs in other areas that get created because of these things as well. So it's just one of those things where the news is going to focus on, you know, Block just the other day laid off 40% of their employees and they said it was because of AI. Well, was it because of AI or was it because they hired way too many people in during COVID, thinking that their business was going to grow to the moon? You can debate which side of it is, but the CEO said it was because of AI, so it must be because of AI. And so everybody's going to jump on this train of the vibes are terrible. We're going to keep sending out the bad vibes. But meanwhile, market's growing. The economy is, I think the GDP print last quarter was in the twos, 2.5 or something like that. So, the market, the economy continue to grow, but the vibes are really, really bad. And they'll continue to be, especially if we watch the news. So let's just focus on what we can control and what we know in terms of investing. And when you're investing in companies, you are an owner of those companies. Companies want to grow. They're going to grow one way or the other. That's what they do. And so just continue to own those companies. That's my thought. So the last topic I wanted to get in here was more of a planning topic. And the reason I wanted to get into it is because all of this is driven back to the plan, and what we talk about with our clients really in the meetings tends to be the plan, not so much how the performance is going. Performance matters because it's built into the plan, but when we do our plan, it's based off of pretty conservative assumptions. Now, the other thing that we assume when we build a plan, even if you're young, is we assume that your spending is going to grow, and it typically is going to grow by, I think we just do it by an inflation adjustment, right? So whatever
Yeah.
inflation is, we build in that escalator into your spending. So I saw this chart the other day, and Jay, if you could bring it up. I saw this chart the other day and it made me start thinking is like, well, that's interesting. We're building in spending continuing to rise no matter how old you are. And a lot of that comes down to, yeah, we think when you get older, you're going to have to spend more on healthcare. You're going to have to spend more on, um, you know, maybe ways to get around, those kind of things. But in actuality, your spending tends to go down as you age. So it got me thinking is like we already build in pretty conservative estimates into how much your portfolio is going to grow. And now I'm thinking we're also building in pretty conservative estimates about how you're going to spend as you age. Um, so, so Quentin, why don't you talk a little bit about this and like why does spending peak when you get into your 40s and 50s and why it might actually tend to go down as you get older?
Yeah, so like Steve said, we build in like a 3% inflation assumption, which is higher than what the Fed's target is of around 2%. And that's just because we want to be conservative. Same thing with your portfolios. We put in about a 5% growth rate, depending on the assets and what the intention is for them. Again, to be conservative with that. And what the chart shows is, yeah, when I'm younger, I start spending more, right? I'm 33, I think. I have four children. My spending has gradually increased as I added to my family, right? The grocery bill gets higher, cost of education, putting your kids in, extracurricular activities. Like my daughter just started gymnastics this week. We add to it. We're traveling. Also, Steve made the comment earlier today. When I travel with my family of four, it's way more expensive, or six, sorry. When I travel with my family of six, it's way more expensive than if it was just my wife and I, because now I got to buy six airplane tickets. I got to get two hotel rooms. I have to rent a very large car. So our expenses just kind of gradually go up. And then we hit that point of now we've retired and you know, anecdotally, I don't see people spending less when they
Right.
retire. I actually see them spending probably more just because now they have this freedom, right? We had to show up for our 9 to 5 for the last, 40, 30, whatever it is years. And now we have this time to go spend with our grandkids. We can go travel. Maybe we move to a different state or country. And so a lot of times we see people spend a little bit more in those first few years, and then it starts to kind of level out. Like, okay,
Yeah.
now we're going to maybe stick around home a little bit more, do things a little bit differently. What we have been planning for is the fact that, yeah, maybe you travel less as you get older, but what we have seen is health insurance get more expensive. I mean, here for our business, I think our health insurance went up 8% going into 2026. So we do see that cost getting higher. So we do leave our inflation increase there just because we don't know what's going to happen. You retire when you're 60, we're planning out for you to be 90 years old. I have no idea what's going to happen to you health wise between 60 and 90. Just ask our founder Kerry. He's had a lot of different people, acquaintances in our industry and friends, family that have, at young ages come into medical situations that are, expensive. And we just want to be we would rather bank on you having we'd rather have you spending less in the future because you lucked out and didn't have any medical issues or other things going on in your life and have more than what the plan shows. So we just want to be
Yeah.
conservative in that because we just don't know.
That's what I'm, yeah, that was the thing that stood out to me is just, it just proves how much more conservative we are building those plans. And I love that. I would rather we're planning for something and we're planning for something that's like good, and then you get great. It's the I used to work in pizza delivery, very prestigious industry, and it was always, you under promise and you over deliver. So like the
Hmm.
Domino's back in the day or Pizza Hut, whatever it was, the delivery in 30 minutes, they
Hmm.
did that because they knew they could always get a delivery out quicker than that.
Hmm.
You wouldn't say that if your average time of delivery was 35 or 40 minutes, So it's one of those things where I just love that about what we're doing, and what I've seen in other plans is not the conservative adjustment. It is more like, no, we think we're going to grow your portfolio by 9%. We're going to do all these things that are going to make you, and if you don't get there, man, does it hurt. It really hurts if you don't get to those more aggressive assumptions. So just wanted to end it on a planning topic because I think what we do when it comes to the markets, it flows into the plan, and the plan is going to show you how, kind of bright your future can be.
Hmm.
And ultimately it tends to be even brighter than that, when it comes down to it. So just one thing I wanted to say. So that was all we had for our slides. If you guys have any questions, you can enter them into the Q&A down at the bottom of the screen, and we can answer them. I already have one in there. So it's how does gold fit into our portfolios? So we have a few different models that we run. Currently, there are a couple models that do have a direct gold exposure. Some other models we have get, I call it kind of indirect gold exposure. You wouldn't see like the actual ticker of the ETF that we use to get gold, but some of the underlying ETFs and funds that we have do have exposure to gold. So gold is typically between, I would say, 1 to 3 or 4% of a portfolio. The reason we don't like go overweight, like really go to town with it, is because it is a very volatile uh, thing. It
Yeah.
it will move. Bitcoin is super volatile. Gold is very volatile. These types of things are what we would consider hot sauce. If you really wanted to spice up your portfolio, you add these kind of things. And so we tend to do those in very sparing. portions. We don't have any Bitcoin in any of our models. We do it for clients who would like to have some exposure. But even then, we would say keep it very low because this stuff is super volatile. And if you, especially in a non-retirement account, if you want to rebalance those things, if they go way up, it's going to cost you tax wise. Um, and it's one of those things like if it gets more and more a part of your portfolio, more and more percent, it can really, you know, go down quickly and you'll see those in the returns. Like, well, everything else is doing fine. If your one giant holding does poorly, then you're going to see, oh, I'm not doing very well. So that's the reason we keep it at a pretty small percentage of any portfolio. All right, one more. This one, Quentin, you can take. Do you expect inflation to pick back up as a result of the conflict? Higher oil prices, higher costs.
Yeah, I think what's really going to play into that is how long does this go on? We don't know how long the conflict is going to be happening, and the longer it goes on, probably play more into that. And Steve alluded to that a little bit earlier. Is like oil prices kind of flow into everything, right? It's how, it's how we transport goods from different, countries over here to the US. It's how we move things around here. It's how we get, people get energy. So it flows through into everything and will have an impact on inflation. It definitely, the longer we have the conflict going on, it'll play in longer. But as long as, here the economy is doing really well and people are still spending money and going about things as they were before, Fed might not lower interest rates, but maybe we don't need that. As we saw, it doesn't, it hasn't impacted us before. We can kind of continue to grow even under a higher than what we would like it to be.
Yeah.
And ultimately, we will have maybe, I think the average uh, cost per gallon went from $3 to $3.11, which was the highest single day increase since Russia, when
Mm.
Russia went into Ukraine. We had that
Yep.
experience there, and oil prices went up here for the time being because it's like, oh no, how is this going to impact us? How is this going to impact the economy? And we saw that too in South Korea. They just the other day, their market got hit pretty hard because they get a lot of their oil from the Middle East. And if they can't get it now, and like that's how they run their manufacturing plants, that's how they're going to get oil to ship to us. So it's impacted them. But yeah, it's going to cause higher prices. For how long? Who knows? And then it's whether or not, the economy can sustain it.
Yeah. And the good news about oil is that it's kind of a self-regulating industry to a certain extent. When prices get high, the oil producers are going to want to, drill more. They're going to want
Hmm.
to extract more oil out of the ground. And
Drill, baby,
so,
drill.
yeah, exactly. So at higher prices, we're going to make more profits. So we're going to start doing that more. And so it's one of those things where there tends to be kind of a ceiling on prices when it comes down to it. Now, the other thing that happens when we have this kind of conflict in the Middle East is there's the Strait of Hormuz, and it's probably not something you hear about a lot, but when something happens in the Middle East, it's definitely something that gets talked about. It was I think I saw a news article that it was closed over the weekend, but that's not technically true. There's still things flowing through the strait. So it's one of those things where I don't know exactly how to translate, oh, it's closed. There's now people have to go all the way around Africa to, the oil tankers
Hmm.
have to. It's one of those things where yes, it does. That just ends up costing more because oil's higher. It takes longer to get to places. So that's another reason why oil spikes a little bit. But luckily, there is that mechanism of, hey, if prices are this high, let's drill some more. We're going to get more profits in this time, and that should, kind of slowly lower the price as well. So it's just one of those things where from a long-term perspective, if the conflict goes on longer, yes, we will probably see higher oil prices for longer. What does
Hmm.
that translate into, like the inflation that we see? Yeah, obviously we're going to pay more at the pump. Does it mean we pay higher prices at the gas at the
Sure.
at the store. I don't know. It's all of these things are really hard to know. The other thing that comes that I come back to every time I talk about this is, guess what? When you then own the companies that are charging the higher prices, that's the best place to be. It
Hmm.
you know it yes, it hurts in your wallet, but maybe your 401k does better because you're investing in the companies. So it's one of those things that there's the effects of this can be felt on both sides. The best thing to have to own when there is inflation is stocks and housing. Those are the things to own, and so it'll always come back to that. All right, I don't see any more Q&A questions, so thanks everybody else for joining us. We had a good time, Quentin. Thank you for doing this. Thank you for finally being here when I've asked you
Thank
in
you
the
for
past.
choosing me, Steve. I know
So thanks.
every time I've
Yeah.
been gone, I think.
I'm pretty sure I've asked you like 2 or 3 times, and you've been gone each time. So
Yeah.
finally got to do it. I'm glad we did. So thanks everybody for joining us, and have a great rest of your day.